For most of the last 50 years, the big fear was overpopulation. Too many people, not enough resources. But today, countries are now concerned about pretty much the opposite problem. Aging, shrinking societies trying to run 21st century economies on 20th century demographics. So today, we're diving into one of the hardest macro puzzles of our time. We'll cover what the demographics look like, how that poses serious problems for the future, and how economies can potentially avoid catastrophe. My name is Lewis, and you're watching Coin Bureau Finance. First up, I must make one thing clear, and that is that I am not a financial advisor, and nothing in this video should be considered financial advice. This is purely educational content meant to inform you about the major economic challenges of aging populations. And if you want to see more macro-focused videos like this, then hit those like and subscribe buttons and flick that notification bell too so that you don't miss our next video. Alright, let's jump right into it. The basic story here is that people are having fewer kids, and they're living much longer. That doesn't really sound disastrous, but at scale, it completely rewires how economies work and gives us some of the most challenging problems that we've had to face as a species. Sounds dramatic? Well, let's dig deeper. The world's share of people aged 65 and over has almost doubled since the 1970s and is on track to double again from around 10% today to just over 20% by around 2074, according to the UN. At the same time, the headcount of over 65s is marching towards roughly 1.5 billion people by 2050. On the longevity side, we've basically hacked a big chunk of early and midlife death. Global life expectancy jumped by more than 6 years between 2000 and 2019 alone, thanks to better healthcare, cleaner water, and a myriad of other public health wins. If we add in all the new treatments and better survival for chronic diseases, we end up with millions more people living well into their 80s and 90s than any pension planner in the 1960s thought was remotely realistic. But the real twist isn't so much that people are living longer. It's that the supply of newborns coming in at the bottom of the pyramid has fallen off a cliff. Across the rich world, what used to be the quote-unquote normal family of 2 or 3 kids has quietly become 1 or maybe 2 kids, if that. The OECD says family fertility has halved from about 3.3 children per woman in the 1960s to just 1.5 in 2022, miles below the 2.1 replacement level. That's a complete overhaul of what future populations look like. And some countries have smashed through the floor. South Korea is one extreme case. Its fertility rate dropped to 0.72 in 2023, the lowest in the world, as women delayed or skipped childbirth altogether over worries about career damage and living costs. In 2024, it nudged up slightly to about 0.75, but that's still nowhere near enough to stabilize the population. And Italy isn't far behind in these rankings either. The country recorded around 379,000 births in 2023, the lowest number since national unification in 1861, and fertility has slipped to around 1.2 children per woman. Almost 1 in 4 Italians are already over 65, which is not a great ratio when you're trying to grow an economy, fund pensions, and keep small towns alive at the same time. So why are people having fewer kids, even in places that claim that they want more babies? Well, for starters, although it may sound paradoxical, part of it is success. Thanks to improved healthcare worldwide, when child mortality is low and trending lower, parents don't need 6 children to make sure 2 survive. There's also been a major shift in gender norms, particularly in the West. As women get more educated and more job opportunities, they tend to marry later, have fewer children, and have children later. Money, of course, is a huge factor too. One American family survey found that 70% of respondents believe raising children is too expensive, and finance was cited as the top reason they capped or plan to cap family size. Housing, childcare, unstable jobs, and a general feeling that raising kids has become a very expensive life choice. The desire for kids is still there, but the bank account and the calendar just aren't cooperating. Of course, another factor that can't be overlooked is birth control. Once reliable contraceptive becomes widely available in the country, it leads to fewer births, as you might expect. Research from the University of Washington found that broad access to modern contraceptives, along with basic education for girls, is one of the biggest drivers of failing fertility around the world. One other overarching theme in this shifting dynamic is arguably the most concerning. There's a crisis in relationship formation. Teen and young adult romance has been trending down, with studies and commentary linking the drop in dating to heavy smartphone and internet use. More time spent online means less time spent socializing in person and forming real relationships. Meanwhile, that cost of living crunch means more adults are living at home with parents or sharing with roommates well into their late 20s and 30s, mainly to cope from high housing costs. For Western cultural norms in particular, that's not an environment built for stable couplehood or starting a family. If we add on other shifting social norms, such as less stigma around being single, less stigma around being child-free, and a growing refusal to accept old-school domestic roles, the number really starts to make sense. So the question then becomes, why is all of this such a concern? Well, particularly among top developed economies, health systems, pension schemes, and labor markets were built for the opposite setup. That meant a big base of tax-paying workers supporting a relatively small group of retirees. That setup has flipped, but institutions haven't, and that's where trouble really starts. Economists track this with something called the old age dependency ratio. How many people aged over 65 there are for every 100 people of working age. Across the developed world, that number has been climbing for decades and is set to keep climbing as the big baby boomer cohort moves fully into retirement. In Europe, the share of people aged over 65 relative to those aged 20 to 64 was about 36% in 2022. By 2050, it's projected to reach 55%, and by 2100, it should be 65%. Back in 1950, there were roughly 8.5 working-aged people supporting each retiree across the OECD. By 2050, that's expected to fall to something like 2 workers per retiree. Now, it's important to remember how pensions and healthcare are actually funded in most advanced economies. They're mostly pay-as-you-go systems. Today's workers fund today's retirees on the assumption that tomorrow's workers will fund them. That's what people sometimes refer to as the intergenerational contract. But population aging could tear up that contract. If you get more retirees per worker and those retirees are living longer, the cash flowing out to pensions, healthcare, and long-term care grows faster than the cash flowing in from a shrinking tax base. Aging populations can be linked to weaker growth, lower labor supply, more pressure on public finances, and even fewer new ideas as smaller cohorts generate fewer entrepreneurs and innovations. That is the backdrop for people like legendary hedge fund manager Stanley Druckenmiller, who talks about a, quote, generational theft. He's spent years arguing that US entitlement programs like Social Security and Medicare transfer too much to current seniors at the expense of younger and future taxpayers, calling the situation a bigger looming storm than the 2008 crisis. Whether you like this framing or not, the basic numbers are hard to argue with. Aging societies end up with slower labor force growth, which drags on GDP, and they owe ever larger sums to retirees. That combination pushes governments towards 3 options: cut benefits, raise taxes, or borrow more and hope growth saves the day later. None of those are really vote winners. So you get what we've been seeing so far: political trench warfare over pensions. France is a good example. The government's now frequent moves to raise the statutory retirement age have consistently triggered mass protests and strikes, even though many other OECD countries are already heading beyond 65. This year, France's own audit office said flat out that keeping the current pension system unchanged is impossible. Pensions already consume around 14% of France's GDP, with officials warning that the status quo is unsustainable without changes to working lives or benefits. But it's not just France. Most of the rest of the world is faced with the same fundamental problem. As populations age, governments are squeezed between older people who don't want their benefits cut and younger cohorts who are already dealing with high living costs, heavy taxes, and weaker safety nets. If your country has promised decades of comfortable retirement to a giant cohort that's now living longer with fewer workers coming up behind them, then something has to give. But how does all of this pressure of an aging population show up in our everyday lives? Well, let's first look at our labor market. A recent survey found roughly 2/3 of Japanese companies say labor shortages are already seriously hurting their business as the population shrinks and ages. And with that, wage deals are finally popping. Japanese firms agree average pay hikes of around 5.25% in 2025, the biggest in 34 years, explicitly to cope with worker scarcity and inflation. Elsewhere, to stop experience walking out the door, governments are bribing seniors to stay. Germany will from 2026 let retirees earn up to $2,000 a month tax-free if they keep working, an active pension aimed squarely at demographic labor gaps. Speaking of taxes, there's also the tax and services side of things. As the retired population grows, governments end up spending a larger share of their budgets on pensions and healthcare. But that usually means a smaller share spent on things younger people care more about, like education or transport infrastructure. From a young person's point of view, this translates to higher taxes but tighter public services. Younger households pay more into systems increasingly geared towards older voters, and resentment between generations rises. And when governments do try to rebalance, say by raising retirement ages or tweaking benefits, the political blowback is immediate. Another issue in aging populations is rural depopulation. In Italy, 0 births were registered in 358 towns and villages in 2023, up from 328 just 5 years earlier. Whole communities are sliding towards literal extinction. Japan is even further along. Government data shows roughly 9 million vacant homes nationwide, about 13.8% of the housing stock, double the share in the early 1990s. Foreign buyers can now pick up some of these houses for the price of a used car, and you'll find countless YouTube videos showing people doing exactly that. Consumption and innovation are also impacted by the age mix too. Older households, on average, hold more wealth and spend heavily on health, leisure, and financial services. That has turned longevity into a giant business sector and led to the term silver economy. Basically, all the goods and services consumed by and designed for people over 50. One recent review puts this global silver economy at more than $15 trillion today and heading towards roughly $27 trillion within a couple of decades. Companies chase that money with health tech, senior-friendly housing, and automation to replace scarce workers. And all those adjustments show up as persistent sector growth. So economies may be aging, but certain sectors continue to thrive as the shift continues. And if you're looking to take advantage of that shift, then you should check out the Coin Bureau Deals page. Over there, we have numerous finance-related deals and bonuses exclusively sourced for the viewers of this channel. To check that out, just scan the QR code over here or click the link down in the description. These deals won't last forever though, so take advantage of them ASAP while you can. Now, back to the video. So, what can countries do in the face of these demographic challenges? Well, as it turns out, quite a bit, and they're trailing a bunch of efforts. For starters, policy can be geared toward helping families. South Korea is now pumping the equivalent of around $13.7 billion a year to work-family balance, childcare, and housing measures to nudge births up, a 22% jump on last year's budget. The government of Poland recently signed a law introducing zero personal income tax for parents raising 2 or more children, up to a family income of around $38,000 per year. Then, as we mentioned earlier, there's keeping people in the game for longer. Raising pension ages is the blunt tool. But what's more interesting are carrots, like Germany's new active pension, which lets people who stay in the workforce beyond 67 years keep more of what they earn tax-free. In addition to that, Germany, like many other countries, is looking at immigration. Germany's Skilled Immigration Act created easier routes and even a points-based opportunity card to pull in non-EU talent and plug labor shortages. But of course, such measures are becoming increasingly contentious. Smart immigration policy can buy some time, but they also need housing, schools, and politics that don't explode the moment you mention more newcomers. It's also imperative that skilled immigration is genuinely skilled. Otherwise, economies risk worsening, not easing, the pension squeeze. Canada has leaned heavily on immigration in recent years to offset aging, but much of the inflow has come via student visas and a parallel ecosystem of low-quality private colleges dubbed diploma mills. That has raised fears that many arrivals won't become the highly productive, high-tax contributors the system needs. But while some countries grapple with these contentious issues, others are more focused on redesigning pension schemes themselves. The Netherlands, for example, is shifting from traditional defined benefit promises to a collective defined contribution system. Contributions flow into individual pension pots, but investment and longevity risks are pooled across the fund. The idea is to make promises more transparent, link outcomes more clearly to what's paid in, and avoid massacring younger workers if returns disappoint. Now, there is a lively argument over how this will play out in the long run, but the bottom line is that countries are acknowledging a need to take serious action to address the pension issue. In addition to all of that, there are other, softer things countries are doing to help this demographic transition. Cities and villages are being re-engineered for an older population. Manchester, England, for example, is planning a $1.5 billion age-friendly neighborhood around a redeveloped hospital site. It aims to mix adaptable homes, green space, and health tech businesses so people can age in peace and with grace. At least, that's the vision. Meanwhile, rural Italy is looking to the carrot to reshape and revitalize communities. Regions like Trentino are offering grants of up to €100,000 for families willing to move into shrinking mountain towns and renovate abandoned homes. Not a bad deal. Now, the solutions we mentioned are all well and good, and many of them will yield positive results. But it's quite likely that these measures won't be enough. The demographic trajectory for the next few decades is basically fixed. Populations are aging, and we're not conjuring millions of extra workers out of thin air. Like the Netherlands and other countries, economies worldwide will have to restructure their pensions and welfare systems, not just make small adjustments or sprinkle incentives on top. Simply put, tough decisions need to be made. As we mentioned earlier, Stanley Druckenmiller has spent years arguing that current entitlement systems effectively overpromise to older cohorts at the expense of younger taxpayers. With respect to the US, Druckenmiller's basic point is that long-lived retirees are getting more out of the system than they put in, and someone behind them has to plug the gap. One obvious answer is that wealthier retirees take more of the strain. That would include tighter means, testing so rich retirees get fewer subsidies, faster increases in pension ages where life expectancy has risen, and more tax on accumulated assets instead of just hammering wages. And we're already seeing hints of this. The IMF has urged the UK to scrap its costly triple lock pension guarantee and look at higher contributions from better-off households to keep the system sustainable. If politicians duck hard choices like this, the adjustments land on younger cohorts by default. Higher age-related spending and weaker growth means either bigger tax bills over their working lives or smaller benefits when they finally do retire, or both. Ouch. Absent any significant action, younger generations inherit lower growth while shouldering the cost of more retirees, as the traditional flow of wealth from old to young erodes. That's the outlook for millennials and Gen Z trying to juggle housing, families, investing, and aging populations all at once. But we're not going to go deep down that doomer rabbit hole here. There are, after all, some wild cards that could soften the blow. One is a genuine productivity boost from new technology like AI and automation. Over the long term, that is. AI has the potential to revive sluggish productivity growth by automating routine tasks and amplifying human work, especially in services. If deployed well, emphasis on the well, AI could help ease the demographic transition we're currently seeing worldwide. Consider that alongside with the initiatives that we covered earlier, and you can imagine a world where longer working lives don't automatically mean longer misery, and where smaller workforces still produce plenty. Of course, none of that is guaranteed, but sometimes it's important to shift the focus from what can go wrong to what can go right. There are big concerns when it comes to the issues of aging populations, but this is not an insurmountable hurdle. So, that is our outlook on the issue. But what do you think? Which policies best address the conundrum? Or is there simply no hope left for humanity? Let us know your thoughts in the comments below. And if you want to learn more about why the economy feels like the rich are getting richer and the poor are getting poorer, then you could check our video on that right over here. As always, Thanks for watching, and please consider sharing this video with anyone you think would enjoy it. It's Lewis, signing off.